We continue with our discussion on mutual funds, and in this particular section, we're going to kind of spend some time looking specifically at debt funds and what are the parameters that are important. So far, most of the funds that we have looked at are equity funds. Now we're going to turn our attention towards debt funds and probably look at examples of debt funds and understand what are the key parameters that are typically there within debt funds, right? So for debt funds, we need to revisit a few of the earlier criteria that we've already kind of studied. Credit rating of the underlying bonds, tenure of the underlying bonds, and duration of the underlying bonds become important parameters while selecting debt fund. What is credit rating? Credit rating is basically going to tell us about the riskiness of the bond. Tenure is the time to maturity, and time to maturity is useful in terms of explaining what kind of risks the fund has in terms of the amount of time it will take before it returns your money. And duration is basically a measure of interest rate risk, right? Also typically used, the parameter used is called as modified duration. And these are three of the more important parameters that are there for the fund. So effectively, when we are looking at a debt fund, these three parameters assume paramount importance when we are evaluating a debt fund, right? Now, what is the risk in the bonds underlying the portfolio is going to be given by the credit rating. What is the average tenure of the bonds underlying the rating is going to be underlying the portfolio is going to be given as the tenure, and what is the interest rate sensitivity is going to be given as duration. Remember, if the duration of a fund is 2 years, it's typically denoted in year terms, then a 1% change in interest rates will mean a 2% change in price in the opposite direction, right? So plus 1% would mean minus 2%, and minus 1% would mean a plus 2% increase in price, right? So that's what duration does. And tenure is basically the time till which the bond will last, right? Let's take an example and understand a debt fund slightly better. So for an example perspective, we're going to use a fund called Reliance Regular Savings Fund, debt fund. And we're going to study some of the data points that are available from the fact sheet that Reliance issues. So this is a fund that has a monthly AUM average of about 6,800 crores, a fairly big fund in terms of data. There is some sort of, so the fund manager is Mr. Prashant Pimple. There are a few important parameters that become very, very relevant for us when we are looking at the debt funds, right? So the first thing that we have to look at is what kind of return the fund is giving, what is the duration, and what is the broad maturity, right? So let's look at those parameters. What we see here is that the return expected from the fund, or average YTM of the fund, is 9.69%, right? What do we mean by YTM? YTM basically means that if you have the weighted average maturity of the fund is 2 years, so if you hold it to maturity, which is 2 years effectively, and the fund doesn't really change its bonds during this period, then you expect a return of 9.69%. If the fund does not change its portfolio from now on till the maturity, and you hold all the bonds and the fund till the maturity of all the bonds, and the fund manager also does the same, you will probably end up with a 9.69% return. There could be changes, obviously, because the fund manager may choose to, let's say, sell this and buy this, and some of those kind of things might happen, which changes the portfolio and changes the weighted average maturity as well. Typically, your weighted average maturity, which is 2 years, is useful from the perspective of your calculation of the data, that if your investment horizon, typically what you want to do is your investment horizon, how long do you want this to be invested, should be equivalent to the weighted average maturity. Usually this thumb rule makes risk lesser in terms of it tries to match the investment with the tenure of the fund requirement that you have. We also see modified duration is 1.63 years. So modified duration is equals to 1.63 years. What does this mean? For a plus minus 1% change in interest rate, there will be a minus plus 1.63% change in bond portfolio value, right? So if interest rates are expected to go up by 1%, this portfolio will lose that amount of value, right? So effectively, your net return would be 9.69%. That's the expected annual return. And if I say that, okay, there is going to be a 1% increase in rates, that means you will on average lose 1.63% on account of this. So your net return will be 8.06. Remember, that's the expected return. It is not necessary that you get that return. It is not 100% certain that you're going to get that return because the fund portfolio could change from time to time. The yield could change time to time and so on and so forth. Also remember, the duration of the fund is nothing but the weighted average duration of all these bonds that are there in the fund, right? So there are some approximation issues that might happen here because the duration assumes that the change has to be equal for all the bonds, right? The interest rate has to change equally in all the bonds. That may not happen, right? We are saying 1% change in interest rate. That's the government interest rate. That may result in the interest rate or yield on this bond changing only by 0.5%, for example, right? So some of those changes are advanced concepts. We don't need to worry about them right now. What is important for us is that broadly, what kind of return is expected? Can we calculate that? So that's a function of the weighted average YTM and what is your expectation of interest rate change on the bond, right? There is a third concept that will come in, which is something called as the expense ratio. We will introduce that at a later stage, right? For now, we don't need to kind of look at the expense ratio. That's fine. So if you expect the expenses on the fund to be of the tune of another percent or so, you subtract that percent from this 8.6%, 8.06% as well to get to that number, right? Next, you look at what kind of rating profile exists in the underlying bond portfolio, right? So this is what we are looking at. This highlighted rectangle is what we are looking at. So we see that the bond profile in terms of credit rating is kind of varied. The AAA rated bonds or sovereign bonds or A1 plus bonds. Now, what is the difference? The long-term ratings are AAA, AA, A. The short-term ratings are A1, A2, A3, and so on and so forth. So if the bond is less than 1 year, then you will look at short-term ratings. That's how CRISIL rates, for example, or ICRA rates, right? So you'll see AAA or sovereign, which is the government rating, or A1 plus or cash is 13%. This is the highest safety, right? That's the highest safety segment that is there. Then you look at AA plus. Now within a category, for example, you have AA and you have some defined limits where the rating goes to AAA and the rating goes to A. It's possible that there are some bonds which are slightly better than the average AA rating, but not good enough to be AAA. You call them AA plus. Then there are some which are slightly worse but not bad enough to go to A, they are AA minus. So you see AA plus is 16.95, then AA is 21.75, AA minus is 27.48, then A plus, A minus, A1, all that. There are some instruments which are unrated, right? These are bonds which are not really rated by any rating agency, and that plugs in here. So this is the credit profile of every debt portfolio. Another important parameter that when you're looking at a debt fund, you have to look at the exact rating profile of what are the underlying instruments, right? So individually, which company has rated what bond is given in front of each of these bonds if you look at them carefully. The third part is broadly trying and finding out the asset allocation. What kind of bonds are available, right? So when you look at asset allocation, there are various kinds of things. Corporate bonds. So first thing we need to understand is that if you remember the debt concepts, instruments less than 1 year maturity are called as money market instruments, right? In this, you have certificate of deposits, which is this CDs. CDs are issued by banks. You have commercial paper, which is CPs. CPs are issued by other corporates, right? If you have a maturity of greater than 1 year, all that falls under corporate bond. Everything of that is corporate bond. Then you have zero coupon bonds. We know what zero coupon bonds are. They don't pay any coupon. They just pay the bullet payment at the end of it. So that's zero coupon bonds. And zero coupon bonds, if you remember, have no reinvestment risk. If you invest 80 rupees and it gives you 100 at the end of 3 years, there is no reinvestment risk because there's no coupon payment in between that is happening. And then you have cash. So bulk of this portfolio is concentrated in corporate bonds. There are some zero coupon bonds which also are likely corporate bonds. Commercial paper, which are short-term corporate bonds. Certificate of deposits, which are short-term bank bonds. Basically, banks raising money through this thing is certificate of deposits. And that's your debt portfolio. So broadly, there are three major things that you have to look at. You have to look at the parameters around the YTM, weighted average YTM, yield to maturity, the parameters around modified duration and weighted average maturity. You have to look at the rating profile, and you have to look at the asset allocation that a bond fund has effectively, right? Now let's extend this and let's try and compare two of these, right? So we've taken two bond funds here. One is the Reliance Regular Savings Fund, which we just saw. The other is Reliance Corporate Bond Fund, right? Now let's compare things. Average YTM is higher here, right? 9.69%. Modified duration is higher here, which means the interest rate sensitivity of Reliance Corporate Bond Fund would be higher. That's 3.46, almost twice, right? So for a 1%, let's say interest rate declines by 1%, regular savings fund will give you 1.63% upside plus, and this fund would give you 3.46% upside plus. That's assuming interest rates go down by 1%. Weighted average maturity of this is 2.2 years. This is 5 years. So if you want to park your funds for 2 years, probably regular savings fund debt is what you would look at. If you want to park your funds for 5 years, then probably this is what you're going to look at. In terms of rating profile, right? In terms of let's look at asset allocation, you'll find corporate bond and zero coupon bonds are close to about 94%, almost 95%, in fact, more than 95%, and cash is 4%. Here you have corporate bond and zero coupon at 91, and you have some short-term bonds which are not available in this case. There are no CDs, there is no CD, there is no CP, no certificate of deposit, no commercial paper that is available here, right? So the profile is largely long-term in that case, and the profile is largely long-term here as well, but there are some short-term instruments which are available in this as well, right? Now, when we look at the other details, so broadly, the allocation is similar. It's just that the maturity is different. So that's what we are broadly looking at. Now, however, interestingly, you see that the return, now we think that as tenure increases, the YTM should also increase, or return expected should also increase, right? That's not the case here. As tenure increases, the return actually decreases. The return YTM expected actually goes down. Why might that be happening? Could that be something to do with the rating profile? Let's look at that here. We've already seen that this has a AAA rated bonds at about 13.35%. Everything else is second grade onwards, right? Here, AAA rated bonds are at around 38%. So if you look at AAA rated bonds, that's 13% in one versus 38% in one. So it's largely possible that this portfolio is a slightly riskier portfolio. And because it is a riskier portfolio, the expected return on this is slightly higher. Why is it riskier? Because it has a lesser proportion of AAA rated bonds that are there. Corporate bond fund has a bigger proportion of AAA rated funds. So now in what kind of environment would you invest in fund A? While it is not very clear from the discussion we've had so far, but usually if your investment horizon is somewhere around 2 years, you will choose this fund. If it is 5 years, you will choose this fund. If you think interest rates are not going to move, then you probably choose this one. If you think interest rates are going to go down, then you choose this one. If you think interest rates are going to go up, then you do not choose this one, surely. Both of them are largely into corporate bonds, so you are kind of taking a profile on corporate credit cycle, either staying where it is or improving from where it is, which means typically interest rates on corporate bonds would go down. So if that is the idea, then you would look at either of these two funds. But looking at broadly the parameters that are there, it appears that based on credit rating, the Reliance Regular Savings Fund is a slightly riskier fund as compared to Reliance Corporate Bond Fund. Obviously, there are more nuances to fund comparison. And when you look at this in more details, it will become bigger and bigger as an area. But for immediate analysis, this is what suffices our analysis, right? So broadly, we are going to look at key parameters, and those key parameters would involve your YTM, modified duration, and maturity for a debt fund. You're going to look at what is the rating profile for a debt fund, and you're going to look at what is the asset allocation for a debt fund, right? We've learned a couple of definitions in this. CD is less than 1 year issued by banks, certificate of deposit. Commercial paper is less than 1 year issued by other corporate. Corporate bond is greater than 1 year issued by anyone. Basically, any corporate is called corporate bond then, right? And sovereign is a rating for the government bonds that come out. So that's basically the premise of all the major things that you have to look at when you're looking at a debt fund. That's broadly what we look at when we are comparing debt funds. Let's end this particular section with a couple of questions. If you're investing assuming that interest rates are going to go down, what kind of funds will you choose? And name any three major parameters that you will evaluate for the debt funds. Thank you.